Hello and a very lovely good evening once again from here in Jolly, and hope as always that each one of you are keeping absolutely fine and are in fine spirits. So on such count, we take up today this particular chapter, as you can see flashing on your screens, Valuation of Goodwill. Looks pretty easy chapter because right from the beginning of your accounting journey, you are associated with this particular topic, isn't it or not? But still, the importance and significance of this particular chapter can be noted from the particular fact that this particular chapter is almost following you like your own shadow, and it is not going to leave you till your what we call accounting journey would come to an end. That is the significance of this particular chapter. So one can gauge very easily the importance and significance of this particular chapter, that in spite of the fact that you have been doing goodwill right from your 11th, 12th, in your BCom, in your professional level, and even till up to the final level, this particular chapter is still with you. Why goodwill is so important, we'll talk about that, but one very important peculiarity of this particular chapter is, which sometimes we tend to ignore. Have you ever noted that in this particular chapter, you have never ever prepared any account? Have you ever? No. This is the what we call biggest peculiarity of this particular chapter, as I told you, in spite of the fact that we are doing accounts, but in case of valuation of goodwill, we never ever prepare any what we call sort of account. We only prepare the statement, that is valuation statement, correct? The statement which reflects the what we call valuation of the goodwill. The accounts are never prepared. Indirectly, it means this chapter is more related to actuarial valuation rather than what we call to an accountant. And most of the time, we will see that whenever the valuation of goodwill is needed, more often than not, we take the help of tremendous experts and who have got very high amount of expertise in the field of valuation. Generally, those are actuaries. So this is the peculiarity of this particular chapter. Second important peculiarity of this particular chapter is that if the same question will be solved by 4 different persons, indirectly, let us say there are 4 actuaries and they are valuing the goodwill of a particular firm, more often than not, chances are quite glaring that each one of them will get a different answer. The reason is very simple. Because the value of a particular thing actually depends upon our need. Now I will simplify it. For example, there is a plot of land. And let us say in the eyes of Mr. A, it is going to fetch 100 lakhs. That when Mr. A is ready to churn out 100 lakhs to buy that particular plot of land, simply because of the fact he needs a flat in a commercial area, high-end commercial area, in an up-end commercial area. And that particular plot of land actually is satisfying all the expected parameters which he is desiring. So quite obviously, he will be able to churn out a very high amount of 100 lakhs. On the other hand, in the eyes of Mr. B, that plot of land, let us say hardly worth rupees 30 lakh, because that particular plot of land is not satisfying his expected criteria. Let us say he is interested in buying a plot of land in a very peaceful place, in a very peaceful area. So that is the reason the value depends upon our need. If our need is very high, we may be able to churn out a very high amount of money. Is it clear to you? Imagine for a while, suppose you are left lurching in a desert and you are roaming about over there since last 7 days and you are not having any water. And suddenly you find a person with lots of what we call water bottles. At that time, you will be able to churn out even your gold chain, correct, to get just one what we call bottle of water. So you can see the value always depends upon the need. And that is the reason in this particular chapter, we see that so many presumptions are actually used to value the goodwill. So we on our side, as always, will do our level best effort to see to it that all possible logical assumptions are taken to arrive over a standard answer. But why I'm telling you all this particular thing? Because there is every possibility that if 5 students would solve a particular question, 5 may arrive over a different answer. Because of, as I told you, the assumptions which we generally take in order to value any particular thing. So these are the 2 important peculiarities. And I need not require to tell you, actually, at this particular level, when we need to do the valuation of the goodwill, you have been studying that even in your partnership which you did earlier, at the time of admission, retirement, death, you used to actually value the goodwill. Similarly, if there is any change in profit sharing ratio among or between the partners, you used to value the goodwill. However, in case of corporate sector, generally the valuation of goodwill is needed at the time of mergers, acquisitions, demergers, at the time of acquisition of business, business combination, consolidation, as we have already seen. But if we are going to surmise the entire scenario, we will come over to a conclusion that most of the time, valuation of the goodwill is needed when one party is selling its business and other party is taking over the business. This is the what we call most common area where the valuation of the goodwill is more often than needed almost at every time. Now, coming over to that chapter. In order to comprehend the intricacies of this particular chapter, especially at this particular level, you need to be very deft, especially with respect to some important concepts. Correct? Because you have been doing goodwill, as I told you, right from the beginning of your accounting journey. As you know, you used to generally value the goodwill on the basis of average profit method, super profits method, capitalization method, and so on. So now, as far as this particular chapter is concerned, it is neither easy, but at the same time, I will refrain myself from calling it a very tough one. But it is a clumsy one. So that is the reason that you need to be very well deft up with all the significant concept of this particular chapter before you can develop the sort of confidence to come over a standard possible valuation of goodwill. That is the important art. So let's come over to the straight point. Whenever the valuation of goodwill is done, the first step, now you store it in your mind, the first step at this particular level, which you are going to do is, you are going to compute the future maintainable profits. We'll talk about what exactly the future maintainable profits are and why we are computing for the valuation of goodwill. But first thing which we'll need to learn is how it is computed. Now, let us say there is a party by the name of Mr. A, and let us say it is selling its business to another party B. Correct? And both the parties are interested in now valuing the goodwill. So the selling party tells to the purchasing party that since last 4 years, let us say we have this much of profits. In year 1, we had this much of profit. In year 2, we had this much of profit. In year 3 and in year 4. Correct? So that means the first of all, we are going to actually add up the profits of the pattern which is given in the question, 3 years, 4 years, 5 years, whatever it might be. Let us say both the parties have agreed to take last 4 years profit. So the selling party tells that in the last 4 years we have had this much of profit. So first of all, we are going to total them up. This is going to be our first step. So we total these profit, as you can see, it is our total profit. This is the first step. After this, under the second step, generally any abnormal loss which might have taken place, correct? Those abnormal losses are added back. This is very important. For example, the selling party may tell to the purchasing party that this year profits are quite low because we have had an abnormal loss. And we know that what is abnormal loss? Abnormal loss means something which is abnormal and it is not going to take place day in, day out. That means if we are going to exercise care and caution, we can stop this particular loss from taking place in future. So that is why we need to add this particular profit, because once you will take over our business, that our profit were low, but it is not necessary that your profits too would be low after taking over of the business, because abnormal loss is not going to take place day in, day out, as I told you. At the same time, now the purchasing party would insist upon this particular fact that if there is any abnormal gain, for example, the purchasing party point out to the selling party that in year 3, you have included some abnormal profit. Now, as per your version, because these are abnormal profits or abnormal gains, so they might have occurred to you, but they might not occur to me. So let us subtract the same. So any abnormal gains or any non-operating profit. What is non-operating profit? Non-operating profits are considered those profits or incomes which you get not by selling your own product or services. Rather, you get it from some other source. For example, your entity might have invested in some other entity and you might have received some dividend or interest. And obviously, you must have included that in your profit. So the purchasing party generally will insist upon this particular fact that we should subtract the abnormal gain and non-operating profits. That means the basic idea between these two parties regarding the discussion with respect to the goodwill is to see to it that under normal circumstances, what would have been the profit. So all the abnormal scenarios will be wiped out, and now the profit, after adding abnormal loss and subtracting abnormal gains and non-operating profit, the total profit has now been adjusted. So it will be known as total adjusted profit, as you can see. It is known as total adjusted profit. And if somebody asks you, what do you mean by total adjusted profit? You should be in a position to deliver a very crisp reply that total adjusted profit is nothing but the profits under normal circumstances. Now, since we have taken a pattern of 4 years, so I'm going to divide it by 4, the number of years. After this, obviously, now we are going to get average adjusted profit. What we mean by average adjusted profit? Average adjusted profit now simply reflects the per year profits which this entity has earned in the past, taking into account the normal circumstances. So this is average adjusted profit, which signifies the earning capacity of this business in the past and under the normal circumstances. Now, once we have arrived over the average adjusted profit, then if there would be any future gains, for example, here the selling party would insist upon this particular fact that you are taking over our business, and here you might have some future gain in the sense that the material which we import for the production of the product which our firm is manufacturing, correct? The import duty on that might be what we call taken off, or import duty might be what we call reduced. So that is the reason you will have some gain in future. Is it clear to you? So if there is any future gain, that means any future savings or gains, those future savings and gains will be added. Similarly, any future losses will be subtracted. Future losses in the sense that, for example, the purchasing party might tell to the selling unit that in order to run your business more efficiently and more proficiently, I may need actually some, let us say, more staff. So quite obviously, then I will have to incur some more expenses. So such future losses will have to be subtracted. And secondly, opportunity loss. What we mean by opportunity loss? Opportunity loss means, here I told you Mr. A is selling the business to Mr. B, let us say. And Mr. B at this moment is employed somewhere else, and over there, let us say his annual salary is 1,20,000. And let us say after taking over this particular business, Mr. B will have to leave that particular job. So quite obviously, this is an opportunity loss for Mr. B, and he will subtract it. So Mr. B will tell to Mr. A, obviously, because right now I am earning 1,20,000 per annum, and I'm going to buy your business. And once I will buy your business, I will have your business, I will have to devote much of the time over there. I cannot, what we call, keep on working with my earlier firm. So I will have to leave that job. So if there is any opportunity loss, that loss will also be subtracted from the average adjusted profit. After that, what we get, because now we have done the adjustments with respect to future also. So now, ultimately and finally, we are going to get, as I told you, this is known as future maintainable profits before tax. Future maintainable profits before tax, correct? And after that, we are going to subtract the future rate of tax, not the present rate of tax. Let us say present rate of tax is 40%, but from next year, the tax rate would be 30%. Then future rate of tax I am going to subtract to arrive over my future maintainable profit after tax. Now, whenever we would say future maintainable profit, that means we are referring to future maintainable profit after tax. Now, what future maintainable profits are? By now, you must have understood it quite clearly that future maintainable profit simply reflects the capacity of this particular firm to earn profits, per year profits in future, after what we call taking into account normal circumstances, both past one and the future one. So this is what we mean by future maintainable profits. Is it clear to you or not? Is it clear? Fine. Then, second step. But before I come over to the second step, this is the second point, in fact. So under the second point, I have first point is related to future maintainable profit. The second point, I simply just want to do a sort of recap. What earlier you used to do in order to compute the goodwill, you used to apply different methods like average profit method, super profits method, capitalization method, correct? Now, at this level, if suppose I would ask you to compute the goodwill through average profit method, so instead of taking the average profit, you will take the future maintainable profit. This is the only difference, as you can see. And remember one thing, future maintainable profits are also average profit because somewhere we have already averaged them, isn't it or not? So average profit method, earlier you used to write profits multiplied with years of purchase, and now instead of writing simply average profit or actual profits, you will simply take into account future maintainable profits. You'll multiply it with the years of purchase, and then you can easily get your goodwill. Similarly, earlier you used to compute your goodwill by super profits method. Do you remember? Under the super profits method, how you used to compute the goodwill? I will simply just recap for you. Let us say there is a firm. This is a firm, correct? And this particular firm is having actual capital employed, ACE. Actual capital employed is 8 lakh and their actual profit is 1 lakh. And let us say normal rate of return is 10%. And let us say as per the agreement, profits need to be computed on the basis of super profits method. Let us say at 3 years or 2 years purchase, whatever you will like to take. So under this method, how you used to compute the goodwill in your earlier phases of education. First of all, you used to take under the first step actual profits or average profits, correct? Whatever is given in the question. And from the actual profit, you used to subtract the normal profits, isn't it or not? You used to subtract the normal profits. And in order to compute the normal profit, what you used to do, you used to take into account your actual capital employed, which is 8 lakh in this case, and you used to multiply it with normal rate of return. Normal rate of return. Do you know the meaning of normal rate of return? Yes, sir, we know. Normal rate of return. First of all, you must have heard this particular word, industry. What is an industry? Let us say this firm, obviously, you know, industry is a bigger word than firm, correct? How? Because what is an industry? An industry is a collection of all the firms which are in the same line of trade. That means in India, let us say all the firms who are associated, let us say with the computer manufacturing or assembling, correct? It will constitute what we call computer industry. So industry basically is a collection of firms which are in the same line of trade. We presume that our firm belongs to computer industry, presuming that we deal in computers, correct? So when we say normal rate of return basically means industry rate of return. Industry rate of return. Normal rate of return basically signifies industry rate of return. And if I say normal rate of return is 10%, what does it mean? It means actually in the industry, all the firms normally get a profit of 10 on the capital of 100. So when we say 10% is normal rate of return, I hope actually you got the now meaning. So normal rate of return signifies basically the general average earning of the firms in the industry. Is it clear to you or not? So in order to compute, after having written what we call average profit or actual profit, then we are going to compute the normal profit, NP. In order to compute the normal profit, what we are going to do, we are going to take into account capital employed, and then we are going to multiply it with normal rate of return. As I've already told you, the capital employed of this firm is 8 lakh. And we are multiplying it with 10%. So when I say normal profit, what does it mean? I have already told you we have got a profit of 1 lakh. That means on a capital of 8 lakh, we are earning 1 lakh. But because normal rate of return is 10%, that means other firms in the industry would have earned only 80,000 worth of profit. That is why in your earlier phases of education under super profits method, you used to compare what we call actual profit with the normal profit. And that is why the difference used to be called as super profits. We still call it super profits, correct? Now, I hope you got a better meaning of super profits now. So super profit simply shows your capacity of earning extra profits, correct, on the same amount of capital. So we may say that on 8 lakh, we are getting 1 lakh. We are getting a profit of 1 lakh, while the industry, the other firms in the market would have got a profit of 80,000. So 20,000 establishes our superiority, isn't it or not? Now, whatever years of purchase, let us say 3 years of purchase, then goodwill will be equal to 60,000. This is how you used to compute. Now at this level, I have already told you what you need to do. You have to simply substitute the words profit by future maintainable profits. The step will remain same. For example, in the super profits method, first of all, you are going to write instead of actual profit or average profit, you are going to write first of all future maintainable profits. Then as I told you, rest of this step would remain same. Normal profits you are going to subtract by applying normal rate of return to your capital employed. And then you are going to get super profit. You are going to multiply it with years of purchase. Then finally you are going to get the goodwill. Is it clear to you or not? I hope so. Now, before I move over to the capitalization method, okay, first let me explain capitalization method, then I will talk about some more points. Now, third method which you used to adopt in your earlier phases of education is capitalization method. Although you know the steps, you are very well deft in it, I know, but I simply just want you to understand the meaning more concretely and more insightfully and in a penetrative manner. As you know, in order to compute the goodwill through capitalization of method, first of all, you need to understand actually why the name of this method is capitalization method. If same question I'm going to solve through all these methods, then more often than not, chances are glaring that I'm going to get highest amount of goodwill through this particular method. Are you getting my point or not? So this is a sort of an advantage in the hands of the firm which is selling the business to ask to apply this particular method, because this particular method which fetch a higher amount of goodwill. As we know, the literal meaning of capitalization means to take opportunity, correct? Isn't it or not? To latch upon an opportunity, to take advantage of something. So, capitalization method. Under the capitalization method, as you know, first of all, suppose now the same question which I have written over here, that actual capital employed of the firm is 8 lakh, actual profit is 1 lakh, and normal rate of return is 10%. Now suppose through capitalization method, I intend to compute the amount of goodwill. First of all, I am going to compute the capitalized value. I have already told you regarding normal rate of return. I'm not going to give you straight away the formula of computing capitalized value, although in your earlier education, you know that capitalized value can be arrived very easily. Simply divide your profits, average profits by normal rate of return, and you can easily get, for example, my actual profit is 1 lakh. If I'm going to divide it by normal rate of return, which is 10 by 100, so I can easily get the capitalized value 10 lakh. But I'm trying to actually elaborate the meaning. Yep, and I will also elaborate upon what we actually mean by capitalized value. See here, normal rate of return of the industry is 10%. No doubt about that. What does this return suggest? I have already told you. This return suggests that normally in this particular industry, on a capital of 100, rupees 10 is the return. That means if you want to get a return of 10 lakh, now reverse it. That means in the industry, as per the industry pattern, if you expect to have a return of 10, you will have to invest 100 lakh. That means as per the industry trend, we may say that in order to get a return of 10, we need to have a capital of 100. Now, because our profits are 1 lakh, so in order to earn 1 lakh, what amount of capital will be required? So 1 lakh into 100, as I have written here, 1 lakh into 100 divided by 10, you can see we are getting 10 lakh. I need not require to tell you that this is the capitalized value. That means other firms in the market would require a capital of rupees 10 lakh to get a profit of 1 lakh. Whereas the reality is that your firm is getting a profit of 1 lakh through what we call investment of only 8 lakh. This is the point I just wanted to bring to your notice. So what we mean by capitalized value? Capitalized value simply signifies the market value of your capital. Because your capital is just about 8 lakh and you are still earning 1 lakh. But you are on par with the firms who have a capital of 10 lakh and are earning 1 lakh. So that is why we may say that capitalized value, that means the market value of your capital actually is 8 lakh. Is it clear to you? So this is just for the sake of understanding. Otherwise, you can simply straightway get what we call amount of capitalized value by dividing, as I told you, profits by normal rate of return. So you can see our capitalized value is 10 lakh. And now I will subtract our actual capital employed, which happens to be 8 lakh. So we can say that in this particular case, we have a goodwill of 2 lakh. Is it clear to you or not? These are the widely used methods which we have seen. No doubt about that. Anyway, now coming over to some other aspects. That is also very important and vital because they create lots of confusion otherwise. Now, next point is concepts of capital employed. So often in the question, we may see actually that we may need to compute the normal profit, and you can just see that normal profits can be computed simply by applying the normal rate of return to the what we call capital employed. But problem arises when question states that normal rate of return is based upon average capital employed. So in that case, you need to compute the average capital employed. And the problem will further get aggravated when in the question capital employed is not given in a straight manner. So in that case, you will have to compute the capital employed, isn't it or not? So these are the things. So sometime, number one, when question does not deliver you in a straight manner the amount of capital employed, you need to have the art of computing the capital employed. And I have seen actually that most of the student fraternity, in fact, is very confused over this. The simple reason is that in normal accountancy, whenever we compute capital employed from the asset, we simply subtract the liability. However, in case of goodwill, in order to compute the capital employed, we have to be a little bit more extra cautious. Why? Let's have a look over here. This is the asset side, correct? First, I have written asset side. And just have a look. And so often in the past also, I have talked about all these facts. Whenever we say asset side, that means in the asset sides, broadly two things are possible. One, assets, and another one is valueless asset. For simplicity's sake, we are using these terms, correct? One is assets and another is valueless assets. What are valueless assets? Valueless assets are either accumulated losses or such expenditure which haven't yet been written off fully. For example, like I have written here valueless asset, profit or loss account debit balance, or preliminary expenses, or underwriting commission, or any deferred expenditure or miscellaneous expenditure. You must have come across towards the asset side such items. So actually these items are basically valueless. What are assets? Accounting framework defines asset as a resource controlled by an enterprise and which is capable of fetching the return. So quite obviously, these items cannot be categorized as asset. Is it clear to you or not? That means while doing the valuation of goodwill, or for that instance, for anywhere in accounts, we never take valueless asset into account for the computation of capital employed. Correct? So on the asset side, you must not actually allow to skip this particular point out of your mind that there are two things, one assets and valueless asset. As far as assets are concerned, for simplicity's sake, we can further divide them into three parts: tangible assets, intangible assets, and investment. Besides the valueless asset, in the asset side, we will have the assets. And assets can be properly, for the simplicity's sake, can be categorized into three parts: tangible asset, intangible assets, and investment. Now, what we mean by tangible asset? Quite obviously, why I'm talking about tangible asset. We will see that at this particular level, I'm not going to ask you what is tangible asset. But at this level, at least you should be aware of this particular fact that tangible assets can be further divided into two more parts: operating and non-operating tangible assets. So here, you must have noticed that you are not aware of this particular point. What are non-operating assets? Non-operating assets, for example, work in progress in the balance sheet. For example, any asset which is still under construction. For example, any asset which you have kept for sale. So non-operating asset means they are assets, no doubt about that. But you are not using those things for your business operations. So that is why they are non-operating asset. And later on, we will see that in order to compute the goodwill, in order to compute the capital employed for the purpose of goodwill, we will never ever take non-operating asset. We will never ever take non-operating asset. That means in order to compute the capital employed for the purpose of goodwill, we are going to ignore non-operating asset. Is it clear to you or not? Yes, sir. Now, coming over to intangible asset. You know what we mean by intangible asset. There are several intangible assets like goodwill, patents, copyright, trademark, licenses, franchise, etc. Now, these intangible assets can be further divided into two parts for simplicity's sake. That is goodwill and other intangible asset. That means I have kept goodwill separately and clubbed all the other intangible asset into the category of other intangible asset. Pay attention. When you will come do the valuation of goodwill, and you will need to compute the capital employed, you will never ever take goodwill also. That means non-operating asset will not be considered and goodwill will also not be considered because you are doing the computation of the goodwill. Is it clear to you or not? And we also do not take into account non-operating asset. As I told you, the reason being is that we are doing the valuation of goodwill. Goodwill is something which is related to the profit earning capacity of the business. And because these non-operating assets have no contribution in the profit earning capacity of the business, that is why they are always left out. Is it clear to you or not? Yes, now the things are getting clearer. And as I told you, assets can be divided into tangible, intangible, and investment. And this is the biggest and most important point here, most significant point. We must know, at least after having reached at this particular level, that investments are of two types, trading and non-trading. And after having reached this particular level, and especially to solve the question of goodwill in a standard manner, you need to be very well deft. Deft means you need to be very well equipped in classifying whether the investment are trading or non-trading. Suppose, how will you do that? Let me also explain it. For example, in the balance sheet. For example, in the balance sheet of a particular entity, I have written investments. I have written investments. Correct? Whatever amount you may like to write. Let us say these are 10% investment. Now, could you tell me whether these investments are trading or non-trading? You won't be able to tell me so easily. You must understand that investments are always non-trading, are always non-trading. What we mean by non-trading? Because our entity has invested the amount in some other entity. That means our funds are being utilized by other entity and not by us. That's a different matter that we are getting some income out of that. That's a different matter. But point I am talking about investments. So investment means we have done some investment in the other entity's financial instrument like share bonds, etc. Correct? Shares, bonds, debentures. So these investment means our funds are being utilized by other enterprises. So quite obviously, these investment will be regarded as non-trading investments. So it will be considered as non-trading investment, NTI, non-trading investment. I give you another example. Suppose in the balance sheet, it is written in this manner, 10% investments. 10% investments. 10% investments in government bonds. Suppose it is written in this manner. Now tell me whether these are trading or non-trading. They are still non-trading. I told you, if we are going, investment means we have invested the amounts in bonds, in shares, in debentures, or any other financial instruments. So again, it will be treated as non-trading. So important point which you need to understand that 99.99% investments are always non-trading. So the point is that you need to know when investments are treated as trading investment. Now I will tell you. Now suppose if it would have been written in this manner, 10% investments, 10% investments, 10% investments, 10% investments, and in bracket it would have been written for replacement of plant and machinery, or it could have been written in this manner, 10% investment for redemption of debenture. That means when there is clue that investment has been meant to finance some activity of the business, then it is treated as trading investment. Then it is treated as trading investment. I hope you got the idea. Is it clear to you? Then it will be treated as trading investment. So important point is that for the valuation of capital employed, under goodwill I am talking about, under goodwill, we will not take, as I told you, non-operating asset. We will also not take into account goodwill, and obviously we are not going to consider non-trading investment. we are not going to consider non-trading investment. Is it clear to you or not? Obviously, I have talked about assets and no question of taking into account valuation, valueless asset. So these are the points which you need to keep in your mind whenever you are going to do the valuation of the goodwill. Is it clear to you or not? Similarly, I would love to actually talk about a little bit with respect to liability side. Because I've seen students have commit lots of mistakes. As you know, liability side for simplicity's sake can be segregated into three parts: capital, reserve and surplus, and liability. Correct? What we mean by liability, first of all, you let me know. Remember one thing. In accounts, whenever we do accounts, and we have been doing accounts right from the beginning of our first day in the class, in the commerce class. In accounts, whenever we do accounting, that means we are dealing with three parties. First party is known as organization or the entity. The organization or entity is always known as the first party. Second party is known as owners of the entity. Owners of the entity. And all the other parties besides these two parties, all the other parties are known as third party or external parties. Debtors, creditors, customers, clients, suppliers, all these are known as third party. So whatever amount is owed by organization or entity to the third party is known as liability. If somebody asks you what is liability, you should be in a position to give a very impressive sort of answer. Is it clear to you? Now, quite obviously, as I told you, once we are thorough, of course, with all the facets of the assets and liability, we are now in a position to compute the capital employed. In order to compute the capital employed, I have already told you we are going to take into account asset, but we are not going to consider goodwill. We are not going to consider non-operating expenses. We are not going to consider non-trading investment. And then I will subtract the liabilities. And when I say liability, that means external liability. Liability always means external liability. We will get capital employed. Just a moment ago, I also told you sometime in the question, normal rate of return is based upon the average capital employed. So often in the past, I have seen students are very confused that when to use average capital employed and when not to use. I will explain this point here itself. You need to compute normal profit on the basis of average capital employed if it is given in the question. If it is given in the question. That means if there is a straight direction in the question that normal profit should be based upon average capital employed, in that case you are left off with no other alternative and you have to compute your normal profit on the basis of average capital employed without an iota of doubt. Isn't it or not? Now the problem arises when no direction is there. If there is no direction is there in the question, in that case you have complete choice, as I told you earlier. In that case, you can apply average capital employed or you can simply take closing capital employed. It is your option. It is your option. But whatever option you pick, kindly put it in the note also. Is it clear to you? So this confusion must not be there now. Anyway, coming over to the average capital employed. Obviously, when question will ask us to compute normal profit on the basis of average capital employed, in that particular case, I have three, you can say, possibility to compute the average capital employed. Quite obviously, the first possibility is OCE means opening capital employed. CCE means closing capital employed. I will simply take the average and I can compute the average capital employed. But the problem is that even if I wish to use this particular method of computing the closing capital employed, I cannot get it fulfilled because in the question, more often than not, we would be given only the closing balance sheet, not the opening balance sheet. So because it is not possible most of the time to use this method, So if we are not in a position to use this method, and to be very honest, we would never be ever in a position to use this method, because generally in the question we are given balance sheet only of the current year. Correct? So we cannot compute the opening capital employed. So that is the reason we cannot use this method, although it is simple. Isn't it or not? So because you cannot use this method, then as an alternative to compute the average capital employed, you will go for this method. CC means closing capital employed. See what we mean by closing capital employed. Whenever we say word capital employed, it always means closing capital employed. Why it is so? Because we are given the balance sheet. Balance sheet contains the closing items. So whenever we say capital employed, it means closing capital employed. And from the closing capital employed, I will subtract 1/2 of future maintainable profit, and then I will get the average capital employed. I will try to explain with a simple example this point which I just wanted to stress. For example, there is an entity. And this entity has, let us say, opening capital employed of 500. Opening capital employed of 500. And let us say its closing capital employed is 700. Suppose if I have got opening capital employed and closing capital employed, in that case, I can very easily compute average capital employed by averaging these two. For example, opening capital employed 500, closing capital employed 700. I will simply divide it by 2 to get 600. This will be my average capital employed. Very simple. Now, just have a look over here. Suppose if I say that my opening capital employed is 500 and closing capital is 700, what does it suggest? The difference between the capital is nothing but your profit. Isn't it or not? Indirectly, it also means that this entity has earned a profit of 200 lakh from the beginning till the end. Now see, if I want to use the second variation, under the second variation, I told you, in order to compute the average capital employed, I will take the closing capital employed. So closing capital employed is 700 and less 1/2 of profit. So profits are 200. You can see still I will get the same answer, 600. Actually, honestly speaking, when we are unable to use this method, this one, we always go for this method because this is the most possible logical method to come nearest to this figure. Although in this example we got the exact answer, but in practical life it is not possible always to get the exact same amount of capital employed through these two versions, but this will give us the closest, correct? And more often than not, we would be using this particular method to compute the average capital employed. And there is another version to compute the average capital employed. This time I have written closing capital employed minus 1/2 of current year profit. Generally, this methodology is adopted when profits are given in a segregated manner. That when current year's profit is given, then you can also go for this particular method. Is it clear to you or not? That is how average capital employed is computed. I hope so that after having gone through all these segments, all these significant points and terminologies and jargons, and especially the computational way of what we call capital employed in respect of goodwill. So you must be having a bit of what we call confidence now, and let us check how much confidence you have developed. So for the same, we will pick up, please pull out your notes, and now we will straightaway take up question number 12. Yes, we are going to straightaway take up question number 12 because I want question number 10 in fact. First, we will begin with question number 10. This is your question number 10. Yes. Why there is need of break? Okay, I will give you a break of 5 minutes. After that, we will continue. Correct? Class is still on. This is very important. Hardly half an hour class has gone by and you people have tired. But return in the class within 5 minutes, okay? So welcome again. So as I told you before taking the break, on account of your request, not mine, we will do question number 10, correct? Just to recap the things which we have done so far. In this question, what is happening? Just pay attention first of all here. It is given that Mr. 20 purchased a business from Mr. 60, correct? And further it is given Mr. 20 is purchasing a business from Mr. 60. 60 is the selling party, and the person who is buying the business is quite vibrant. He is of young age, and profits earned by the seller during the last 4 preceding years have been given to you. These are the profits of the seller of the last 4-year profit. And seller is a very honest person because he is 60 years of age. He informs the purchaser that profits of the year 3 were affected by a loss of goods amounting to rupees 20,000 due to fire. First of all, it tells that profits of year 3, you can notice that profits of year 3 are quite low, and he tells to the purchaser that we incurred an abnormal loss of rupees 20,000 in this particular year, and loss took place due to fire. And he further elaborated that goods were not insured and it is necessary to take a fire insurance policy, an annual premium of which shall amount to rupees 2,500. He told the entire story that this loss took place, number one, and this loss took place because I did not take a fire policy, and if I would have taken the fire insurance policy, I would have had to pay only annual premium of rupees 2,500. Obviously, the abnormal loss later on we will see will be added. Why it is added? Because the party which is selling the business will tell to the purchaser this is an abnormal loss and it will not take place in the future. But now, as I told you, the purchasing party is a very vibrant one, very young but very bright person, Mr. 20. He picked the point out of the story which was just narrated a moment ago by the seller. He told you, sir, obviously we are going to add abnormal loss, but surety of this, the surety of the fact that this particular loss will not take place in future depends upon the fact that I will take an insurance policy. That means indirectly you are telling that this particular loss would not have taken place if an insurance policy on an annual premium of 2,500 would have been taken. So that means I can assure myself, purchasing party is telling that I can assure myself that this loss will not take place, but at the same time, I will have to take an insurance policy on an annual premium of 2,500. So we will see that abnormal loss is added, but 2,500 will become future expense. We will adjust it under the future adjustment. Is it clear to you? Because now the party which is going to purchase the business, it will claim that it will have to incur a future expense of 2,500 to assure that this particular loss will not take place. Is it clear to you? Besides that, there were non-operating profits of rupees 40,000 in year 4. So quite obviously, we are going to subtract 40,000 also because non-operating profits are subtracted. So after doing all these adjustments, we will arrive over what we call total adjusted profit. We'll divide it by 4 to get the average adjusted profit. Once the average adjusted profits are arrived at, then what will happen? We will have to do some future adjustment. Here it is narrated that purchaser was earlier employed in a company on an annual salary of 1,20,000. I gave you the point earlier. This is an opportunity loss. It is given in the question that purchaser was earlier employed in a company on an annual salary of 1,20,000 and now he would leave that job. First of all, he will leave that job. So it is an opportunity loss for the purchaser. So he will subtract this opportunity loss of 1,20,000, correct, from the average adjusted profit. However, it is given that and replace the manager who is at present getting 8,000 per month. Presently, Mr. 60 is having a business, and in this business, there is a manager, and this manager is getting a salary of 8,000 into 12, That is near about 96,000. He is having a salary of 96,000. But it is given in the question that seller will replace this, he will leave the job, but he will replace this manager. What does it mean? That means after taking over the business, the services of the manager will not be required by the purchaser. So it will become a sort of saving for him and it will be considered as a future gain for him. It will be added back. And besides that, you must not forget that under the future adjustment, 2,500 for insurance claim, which he will have to take to assure himself of the fact that abnormal loss is not going to take place. Is it clear to you? So it will be considered as this particular loss. So now we can, and further the question states that we are supposed to compute the goodwill at 3 years purchase of average profit. So we can find out the goodwill very easily. I've already narrated the entire question. First of all you need to do is add up all the profits which are given to you, 3,80,000, 350, 320, 45, 380, and you will get what we call 10,95,000. This is your total profits. Then we are going to add the abnormal loss. We are going to subtract the abnormal profit as I told you. After adjusting these two items, we will get the total adjusted profit. We will divide it by the number of years. Now we have got average adjusted profit. Just a moment ago, I told you what we mean by average adjusted profit. That means per year profits under normal circumstances. Is it clear to you? And from here, we are going to do some future adjustment. For example, loss of salary. It will be considered as an opportunity loss. It will be subtracted. But savings in manager salary is a future gain. It will be added. And fire insurance policy premium. Again, it is a sort of future expense. We will subtract it. After adjusting it, we will get future maintainable profits. Correct? Future maintainable profit. In the question, no tax rate is given. So that is why future maintainable profit will take now. And we are going to multiply it with years of purchase. We will get the amount of goodwill. Is it clear to you? I hope so. Now you have got a bit of command in order to compute the future maintainable profits. Coming over to now question number 11. As far as question number 11 is concerned, here what is happening? The selling party, Sheena, is selling her business. In this case, there is a lady by the name of Sheena, and she is selling her business to another lady, and her name is Shahira. So Sheena is desirous of selling her business to Shahira. Shahira is the purchasing party. Now the owner, present owner, Sheena, tells the former, means Sheena is telling that she has earned a profit of 1,50,000 per annum in the past. This time it is given that she has earned a profit of 1,50,000 in the past. So that means we are already given average adjusted profit, because normally we take the total profits, then we add abnormal losses and abnormal gains, and then we get total adjusted profit, correct? And then we divide it by number of years to arrive over average adjusted profit. But it is given in the question that Sheena is telling to the Shahira that in the past she has earned 1,50,000 per annum. So whenever question would fetch you information in this manner, you immediately come to the conclusion that this time average profits have been delivered to you. Is it clear to you or not? Now, further, Sheena claims that these profits fairly represents the trend of the future profits. That means the selling party is telling to the purchasing party that, in my opinion, the trend of these profits would continue in future. However, we will have to take care of some important things. For example, 1. Chemist fee of 10,000. which is charged against such profit will not be payable by Shahira, as she herself is an able chemist and can work as such. So right now what is happening, Shahina might be having a chemist. She might have kept a chemist. And chemist fee, as you can see, is 10,000. Obviously, this must have been charged to profit and loss account. However, because Shahira, the purchasing party, she herself is an able chemist, she won't be requiring what we call to keep a chemist services, because she herself is an able chemist. So that means it is going to work as a sort of savings for the purchasing party, and that is the reason I will write here future adjustment and savings in chemist fee I am going to add here. Is it clear to you? Now, further in the question it is given rent at 30,000 per annum which had been paid by Sheena will not be a charge in future. Why? Shahira owns her own premises and can supply the accommodation necessary for the staff and the equipment, and the value estimated is 1,50,000. What does this entire scenario of information actually furnishes? Presently, the owner, Sheena, is paying a rent of 30,000 per annum. 30,000 per annum. But as is given in the question, the purchasing party Shahira will need not require to pay a rent. Because she need not require to pay a rent, obviously this is going to be a sort of future savings. So by adding what we call 40,000 to 1,50,000, we come over to the conclusion that future maintainable profit is 1,50,000. 1,90,000, sorry, 150 plus 40. Now the question says that Shahira will not pay rent. Why? Actually, why she is paying a rent? Why the present owner is paying a rent? In order to keep staff and equipment. She might have taken a premises on rent, so that is why she was paying the rent, the present owner. But Shahira will not require to pay the rent. Why? Because it is given that she herself will purchase an accommodation to keep staff and equipment, and she will purchase the accommodation at rupees 1,50,000 rupees. What repercussion this 1,50,000 will have? Remember one thing, when we purchase an asset or building or land, whatever it is, because we are purchasing a premises, so it is a capital expenditure. It is a capital expenditure. Number 1 point. Number 2 point, when Shahira is purchasing the business of Sheena, correct? When we purchase the business of somebody's, obviously we take into account the net assets of that particular entity. Because net assets means basically the capital employed. If I am purchasing your business, that means I will have to pump in the amount of capital employed which you have pumped in your business. Try to understand this point here. The value estimated of net assets of the seller amounted to 18,50,000. The present owner's net assets at this moment is equal to 18,50,000. Now for Shahira, the capital employed will not be 18,50,000. She will have to pump in 18,50,000, but because she is incurring a capital expenditure of 1,50,000, the capital employed of Shahira will be equal to 20 lakh. Is it clear to you or not? This will be the repercussion of 1,50,000, which the purchasing party will have to spend to keep the staff and accommodation. That is how she is going to actually save the rent. Is it clear? It was considered that a reasonable return on capital invested for this type of business in question is 5%. Normal rate of return is 5%. Question says that calculate the amount of goodwill on the basis of 4 years purchase of super profits. On the basis of 4 years purchase of super profits. As you know, under super profits method, first of all, we need to have future maintainable profits, and then we will have to find out normal profits. In order to find out normal profits, we need to have the amount of capital employed. In this case, capital employed, we can easily compute. The capital employed of the present owner is 18,50,000. Of course, this much amount must be invested by Shahira. Besides that, she is incurring another capital expenditure of 1,50,000. So for Shahira, the capital employed will be equal to 20 lakh, and normal profit will be 20 lakh into normal rate of return 5%. That will be equal to 1 lakh. Now you will take the difference between the super profits and what we call normal profits. Now you will take the difference between the future maintainable profits and normal profits to get the super profits, which will be equal to 90. 190 minus 1 lakh. And we are supposed to compute goodwill at 4 years purchase. So 3,60,000 will be the amount of goodwill. Is it clear to you or not? Yes, sir. Similarly, now we will have a look over question number 12. Question states that from the following information, prepare a statement showing capital employed, average capital employed, and goodwill on the basis of 5 years purchase of super profits. Because in this question, directly or indirectly, we are being asked to compute, besides the capital employed, we are being asked to compute average capital employed. So this time, in case if I would need to find out normal profits, I will base it upon average capital employed. Is it clear to you or not? Now, in this question, we are given that We are given some items like goodwill. As you know, for the computation of capital employed, we will not consider goodwill. We are given fixed asset. We will take into account fixed asset. We are given investment in 6% bonds of India, 45,000. Obviously, if I am going to ask whether these are trading or non-trading, these are non-trading. Suppose if I need to compute the capital employed, I will not consider investments. Current assets are given. We will consider current investments. And discount on issue of shares and share selling commission are valueless assets. We never ever consider them. Correct. Besides that, we have equity share capital, preference share capital, reserves, and besides that, we have three liability: provision for tax, 20,000, 10% debenture, 90,000, and besides that, we have got creditors, as you can see. Is it clear? Further in the question, it is given that current value of plant included in fixed asset is 15,000 more. Now, what is happening in this particular question, that your fixed asset have gone up by 15,000. That means your total fixed asset will be equal to 3,65,000 for computation of capital employed. That means whenever you are going to compute the capital employed, in case if there is some revised value, you will consider that. Now it is given average profits of the company. Please rectify this. This is before deduction of interest. Before deduction for interest on debenture and government and after government taxes and after government taxes is 68,000. Is it clear to you? Expected rate of return is 10%, that is normal rate of return. And here in this particular question, rate of depreciation on fixed asset is also given. Whenever you will be given rate of depreciation, you must not forget, as you used to do under your consolidation, you must not forget that the value of your asset has gone up by 15,000. So that means, because value of the asset has gone up, of course there is capital appreciation, it is a gain. But besides that, there will be some loss in the sense that you will have to give some additional depreciation. This additional depreciation will be considered as a sort of future loss. Is it clear? So in this question, first of all, I will compute the future maintainable profit. For that, we are given average profit. And it is given that these profits are before deduction for interest. Before deduction for interest means we haven't yet subtracted any interest from it. And after the government taxes, these profits are given to us as 68,000. The first thing which you need to take into account is that you have invested in government bonds. And in government bonds, you have invested 45,000 and 6% is your return. So each year you must be receiving 2,700 as interest. And quite obviously, interest is always included in the profits. Is it clear to you or not? But we know that this is because investment are non-trading. So quite obviously, this interest will also be considered as non-trading income. That is why I am going to subtract non-trading income, interest on investment, 45,000 into 6%. So non-trading income I will have to subtract. Is it clear to you? As I told you, then I will subtract any future adjustments, that is additional depreciation 1,500, and then we will arrive over future maintainable profit 63,800. Now in this question, we are being asked to compute the capital employed. When we say we are computing capital employed, indirectly it means it is closing capital employed, because we are taking the figures from the balance sheet. I told you fixed asset, we are not going to consider goodwill, we are going to take into account fixed asset, but the value of the fixed asset is now 350 plus 15,365. We are not going to consider investment, but we will take the current investment. Only two items, share selling expenses and discount, we will not consider. So fixed asset, current asset, then you will subtract all the liability, creditors, debentures and provision for tax. So your capital employed will be equal to 3,95,000. In this question, we are also being asked to compute the average capital employed. So in this case, I cannot use the formula opening capital employed plus closing capital employed. So as a second alternative, I will use closing capital employed less 1/2 of future maintainable profit. Our closing capital employed is 3,95,000 and our future maintainable profit is 63,800. 1/2 of that I will subtract from 395 to get my average capital employed 3,63,100. Now I am going to compute the normal profit. in order to compute the normal profit, what I am supposed to do? Now, because in this question, it was being asked to compute the average capital employed, so it is better you base your normal profit upon average capital employed. So average capital employed into normal rate of return, that is 3,63,100 into 10%, that is 36,310. So ultimately, now you have found out normal profits, so you are in a position to find out super profits. Future maintainable profit less normal profit. Your future maintainable profit, you have already computed 63,800. Now you subtract your normal profit 36,310 to get what we call super profits for 27,490. And it was written in the question that goodwill need to be computed at 5 years purchase of super profits. So ultimately my goodwill amount will be equal to 1,37,450. Is it clear to you or not? Yes, sir, it is absolutely clear. We move over to question number 13 now. In this particular question, it is given that balance sheet of Channel 9 Limited is furnished to you and compute the amount of capital employed from the shareholders fund approach and long-term fund approach and find out the leverage effect. Is it clear to you or not? So this is very important for you to understand this particular facet, that in this particular question, we are being asked to compute the what we call capital employed from both these sources, correct? That is from shareholders fund approach and long-term fund approach. So what is the difference between shareholders fund approach and long-term fund approach? So in order to understand that, this is the question number 1. So we will see not only the difference, but we will also see the difference that when we apply long-term fund approach and shareholders fund approach, some difference will take place in the goodwill. That difference is known as leverage effect. Is it clear? Now, in this question, first of all, we go through quickly. We have in this particular question, as you can see, goodwill, tangible fixed asset, 10% trade investment. This time investments are trade. It is clearly given in the question. Current asset. As far as your liabilities are concerned, current liability and 10% debentures, 2 liabilities are also given to you. Further, it is given your average profit after tax rate of 40% is 15 lakhs. Suppose if I am going to ask you, what is your average profit before tax? What is your average profit before tax? Because this is after tax profit is given. So you can compute it in this manner. Suppose my profit before tax is 100, let us say, and 40% is the tax. Because tax rate is 40%, so tax will be 40 and profits after tax will be equal to 60. No doubt about that. If profits after tax is 60, then profit before tax is 100 as per this tax rate. Now, if profits after tax is 15 lakhs, what will be my profits before tax? So I can easily find out 15 lakh into 100 divided by 60. Whatever profit we are going to get. That will be profit before tax. But in examination, every time you cannot or you should not go for such a long approach. You can straight away compute profits before tax in this manner. Profit before tax is always equal to profits after tax divided by 1 minus tax rate. 1 minus tax rate. For example, profit after tax is given to us as 15 lakhs and 1 minus tax rate. 1 minus tax rate is 40% or 0.40. Ultimately, it will be equal to 15 lakh divided by 0.60. So ultimately, you can see we are getting the same things. Is it clear to you or not? Because whenever you will be given profit after tax, it is always better to first convert those profit into before tax. Now question says that investments are valued at 150% of the face value and the face value is 8 lakh. Many a time again I have seen a student create lot of confusion. Face value of investment is 8 lakh. In the outer column we have written 10 lakh. What does this 10 lakh suggest? This 10 lakh suggests the amount which we have actually paid to get the investment of face value of 8 lakh. We got a face value investment with a face value of 8 lakh, but we paid a 10 lakh for the same. Now question is telling trade investments are valued at 150% of the what we call face value. Because face value is given to you as 8 lakh, and if you are going to compute 150% of the same, you will get 12 lakh. So that means the value of your investment now is equal to 12 lakh. Is it clear? Further, it is given in the question, rate of tax in future will be 30%, because our balance sheet date is 31st/3/2019, and from 1/4/2019 question says that tax rate will be this much. Is it clear to you or not? Right, sir. So first we come, and then one more thing in this question is given your normal rate of return as per long-term capital employed. That means there are two approaches to compute the capital employed. One is long-term capital, long-term fund approach we call it, long-term capital employed, and shareholders fund approach. Correct? Normal rate of return under both these approaches are different. Now first part A, calculation of goodwill as per shareholders fund approach. Remember one thing. Whenever we talk about capital employed, we generally talk about shareholders fund approach. Is it clear to you or not? That means hitherto, till up to this particular point, whenever we computed capital employed, that means we computed capital employed as per shareholders fund approach. Is it clear to you? So as per shareholders fund approach, or simply as you normally compute capital employed, you will have to apply the same what we call rules. Tangible fixed assets are given in the question as 60 lakh, so we will consider 60 lakh. Goodwill will not be taken into account. I have already told you. I just told you the value of investment has gone up to 12 lakh, and current asset is equal to 14 lakh. Current asset we will consider 14 lakh, and in this question trade investments are also being considered, but these will be considered at 12 lakh. So total current asset will be equal to 80 lakh. Total asset, not total assets, will be equal to 86 lakh. There are two liabilities, debentures and current liability. We will subtract, and we can get in this case capital employed. If I am going to subtract 18 lakh from 76 lakh, I think it will be equal to 78 lakhs or 76 lakh. Just allow me a second. 86 minus 18, that is equal to 68 lakh, sorry. 68 lakhs. So your capital employed is 68 lakh. Correct? 68 lakh is your capital employed as per shareholders fund approach. Now we will compute the future maintainable profit. Future maintainable profit, as I told you, profits after tax are given. So profit after tax divided by 1 minus tax rate. So you can get your profits before tax 25 lakh. So profits before tax is 25 lakh. There are no future adjustment in this particular question. So I need not require to do anything here, but these will be considered as future maintainable profit before tax, because tax rate in future will be 30%. So I will take 30% of 25 lakh, and future maintainable profit after tax will be equal to 17 lakh 50,000. Now we can find out the amount of goodwill, because years of purchase is not given in this question. So whenever years of purchase is not given, so in that case it is always better to use the capitalization method. So first we will compute the capitalized value. As you know, in order to compute the capitalized value, we take the future maintainable profit and divide it by normal rate of remember one thing, you are using shareholders fund approach. So your normal rate of return will be considered as 20%, and 17 lakh 50 divided by 20% will give you 87 lakh 50,000. Is it clear to you? 87 lakh 50,000. Then you are given capital employed. Capital employed, we computed 68 lakhs. In this case, our goodwill will be equal to 19 lakh 50. Now, only difference is that, suppose if I am going to take the long-term fund approach to compute the capital employed, what difference it is going to make? It is not going to make any difference on the asset side. Asset side will remain same, 60 lakh tangible fixed asset, investment 12 lakh, current asset 14, total 18 lakh. Now here I am not going to subtract debentures. If I am not subtracting debentures under the long-term funds approach, that means we are considering debenture also as a part of funds. Is it clear to you or not? So only difference is this. Under long-term fund approach, you will apply the same rule, same methodology. Only thing is that you will not subtract the long-term liability. Is it clear? Debentures or any other long-term loans. And you will subtract only current liability in this particular case. So we can see that our capital employed in this case is coming over to 76 lakhs. Is it clear? And now we will compute the future maintainable profit. First, I will convert the profits into before tax in the usual manner, 25 lakh, correct? There are no future adjustments, so future maintainable profit is equal to 25 lakhs. 25 lakhs. And then tax rate at the rate of 30%, 7 lakh 50,000 is there. So future maintainable profit after tax is 17 lakh 50,000. And here, what you do, because now you are not considering debenture as a liability, you are considering it as a part of capital. So whatever interest which you paid so far, correct? Interest on debenture, 8 lakh is the debenture, 10% is their rate of interest, because debentures you are not considering as a part of liability. So quite obviously, you will not consider interest on the same also as an expense. So that is the reason interest which you hitherto have paid will be added back. So only difference is that means now instead of 1750, 18 lakh 30,000 will be considered as your future maintainable profit. This is the only difference when you are going to apply long-term fund approach. Then you will compute the capitalized value 18 lakh 30. Now normal rate of return under long-term fund approach is 15%. This will be your capitalized value. You will subtract your actual capital employed to get goodwill. And as I told you, the difference of goodwill under these two different methods will give rise to what we call leverage effect. The difference shall be considered as leverage effect on goodwill. That is, as you can say, goodwill is higher on account of long-term debts. Is it clear to you or not? Is it clear? So after having completed till up to this particular point, we'll continue in the next session, and most probably we'll try our level best effort to see to it that this gets completed in the very next session itself. So shall meet you in the next session then.